Most people will never build real wealth from investing. Not because the market is unfair, not because they started too late, not because they did not have enough capital, because they never had a framework. Welcome to the Profit by Friday podcast, where we replace guessing with process, emotion with discipline, and noise with one clear idea every single week. Let us get into it. A woman in Singapore had been investing for 6 years. She was good at picking stocks, really good. Her research was thorough. Her thesis on each company was sound. Her friends came to her for advice. And yet at the end of every year, her portfolio was flat, sometimes down. She could not figure out why. She was right more often than she was wrong. The stock she picked moved the way she expected, but the money was not there. Then she sat down and did the math she had never done before. She looked at her winning trades, average gain of 12%. She looked at her losing trades, average loss of 22%. She had been right 60% of the time and losing money, because every win was being erased by losses that were nearly twice the size. She was not bad at picking stocks. She was terrible at sizing them. That one calculation changed everything about how she invested from that day forward. This is what the risk and reward pillar of the clear framework is built around. Not a feeling about how much you want to make. A specific calculation that determines whether the math of your investing actually works in your favor. Before you commit a single dollar, here is the calculation. Before you enter any position, you need 3 numbers: your entry price, your stop loss, and your target. Entry price minus stop loss equals your risk per share. That is the maximum amount you are willing to lose on this position per share if you are wrong. Target price minus entry price equals your potential reward per share. That is what you stand to make if you are right. Divide reward by risk, and you get your risk to reward ratio. If the ratio is 2 to 1, for every dollar you risk, you expect $2 back. If it is 3 to 1, for every dollar you risk, you expect $3 back. We only enter positions where that ratio is at minimum 2 to 1, ideally 3 to 1 or higher. Here is why the single calculation changes everything. Imagine you take 10 positions. You are right 5 times and wrong 5 times. A 50% success rate. Most investors would consider that mediocre. Now imagine your average winner returns 3 times your average loser. Your 5 losing trades cost you $5. Your 5 winning trades return $15. Net result on 10 trades, positive $10. You made money while being wrong half the time. Now flip it. You are right 7 times out of 10. 70% success rate. Most investors would consider that exceptional. But your average loser is 3 times your average winner. Your 3 losing trades cost you $9. Your 7 winning trades return $7. Net result, negative $2. You lost money while being right 70% of the time. This is the reality most investors never confront. Win rate alone means nothing. Risk-reward ratio alone means nothing. The combination of the two determines whether you make money over time. The woman in Singapore was winning 60% of the time with a risk-reward ratio working against her. Once she flipped the ratio, the same 60% win rate became highly profitable. And now here is how position sizing connects to this. Knowing your risk-reward ratio is only half the equation. The other half is deciding how much capital to put behind each position. The rule is simple. Invest more than 1 to 2% of your total portfolio on any single position. This is not a suggestion. It is a survival rule. Here is what it means in practice. If your portfolio is $100,000, the maximum you risk on any single trade is $1,000 to $2,000. Not $1,000 to $2,000 invested, but $1,000 to $2,000 at risk. The difference is critical. If your entry is at $50 and your stop loss is at $45, your risk per share is $5. To risk $1,000 on this position, you buy 200 shares. Total invested is $10,000. But your actual risk, the amount you lose if stopped out, is $1,000. This is position sizing. And it is the tool that keeps a string of losing trades from destroying your portfolio. Most investors size positions based on how confident they feel or how much they want to make. Neither of those is a number. Neither of those protects you when you are wrong. And you will be wrong. Everyone is wrong. The question is whether being wrong costs you 1% or 20% of your portfolio. When you combine a minimum 2 to 1 risk-reward ratio with a maximum 1 to 2% portfolio risk per position, something remarkable happens. You can survive a long losing streak. You can be wrong 10 times in a row and still have 90% of your capital intact. And when the winners come, the ratio means they more than make up for everything you lost. That is the math that the woman in Singapore was missing. Not stock picking ability. The arithmetic of survival and compounding working simultaneously. This is the final pillar of the clear framework. And it is the one that makes all the others matter. You can find the perfect catalyst, identify exceptional leadership, confirm earnings quality, read institutional accumulation correctly, and still lose money if the math of your position does not work. Risk and reward is not the most exciting pillar. It is the most important one. Amateurs invest based on how much they want to make. Investors invest based on how much they can afford to lose. The difference is a calculation done before the position opens. Learn more at ProfitByFriday.com today. I will see you in episode 7.